Hi, everybody. This is David Millar, and this is our macro real estate market update for the year of 2020. What I wanted to do here was give you an overall look at the real estate market from a macro level, where we've been, where we are now, and where we think we're going. I'll also have market updates that are going to be more specific towards West Sonoma County later on. But this one, I just wanted to give us an overall look for 2020 and where we're going in 2021. Hope you've had an okay year. I know it's been very trying, but the good news is tomorrow is 2021. We can put 2020 behind us, and I think it's going to be a great year for everybody. So let's just jump right in here. We're looking at move.com says that buyers and sellers are quickly jumping back into the market this week after taking a break during the election. We usually see a slowdown after or during the elections because people don't like uncertainty. They want to see what's going to happen. Now that we've got a pretty good idea of where everything's going to be, people are getting back out into the marketplace and are starting to look for homes. This is the Housing Market Recovery Index. It shows where we were before COVID. We were at about a 1.6.5. And then that giant drop when there was a lot of uncertainty and people didn't know what was going to happen. Now we're back up to about 112.8. The market's looking like it's getting very strong again. Why is it getting strong? And what are some of the factors that we need to keep an eye on is what we're going to cover in this presentation today. The number of mortgages in active forbearance. Now, this number here shows that we had about 4.76 million people in forbearance when the crisis started. Now we're down to about 2.79 million. So we're seeing a good shift there. The issue that we want to keep an eye on, though, is the 14.7% of the people that still don't have their payments up to date or don't have a payment plan set up with the bank. Some people are looking at this and seeing our history in the past with 2007 and saying, wait a minute, are we on the way to another bubble burst or another recession? I've got some more information in this presentation. I think that's going to counter this, but it is something we want to be cognizant of and something that we want to keep an eye on. Are prices going up too fast? We're seeing a big jump this year. And again, it makes people nervous. We hear that word, bubble. David, the market, the prices are going up too fast. Why are they? Well, basic fundamentals. Housing prices were notably, and Craig Lazar states this, he says, I'm tempted to say they're very strong in November. The National Composite Index gained 7% relative to its level a year ago. So the market is doing very well. Prices are going up. Why are prices going up? We're looking at about 6.1% appreciation rate versus the norm of 3.8% appreciation rate. A lot of that has to do with supply and demand. What I did here is I set up a graph with the regular 3.8 appreciation. That there was no recessions, nothing ever happened. This would be the appreciation you would have. What I did was I overlaid the actual statistics on top of that. And we've seen a big jump this year. Looking back to 2007, and this is what people start talking about is, are we seeing the same thing happen again? Are we seeing too high of prices? Well, one thing that really goes into play here is supply and demand. Back in 2007, we had a lot of inventory. You can see that orange line in the inventory back in 2010, how high it got, and then the drop off. Right now, our inventory is very low. We're just not seeing a lot of homes being built, and we're not seeing a lot of people putting their homes on the market. So what does that mean for us? What does that mean? Lawrence Young, the chief economist at NAR, stated that such a frenzied activity reminiscent of 2006 raises questions of a bubble and the potential for a painful crash. The answer, there's no comparison. Back in 2006, we had those dubious adjustable rate mortgages. We had 100% financing. People were taxed to the max. We're not seeing that in this marketplace. And one of the questions is, well, what about mortgage debt? we're at a record of $10 trillion, but prices have gone up. People are staying in their homes, and mortgage balances, the largest component of household debt, rose to $85 billion in the third quarter. Is this something to be concerned about? It can be, certainly, and it is something that needs to be kept an eye on, but there's a difference here. I'm going to show you what that difference is. It's the amount of disposable income that is going towards mortgage debt. In 2007, it was 7.21%. Today, it's 3.72%, the lowest it's been in 40 years. So people are saving money, and they're not overtaxing themselves like they were back in 2007. Again, a really good indicator for the market moving forward. So we've got low supply, high demand. We've got the best interest rates that we've seen in the marketplace in 40 years. Above all, the 2021 outlook hinges on the course of the coronavirus. Jed Kolko states, with the recent surge of the election that just happening, there are some variables that we don't have control of. But coming out of coronavirus, one of the big things we need to look at is the shifts in the trends. We're seeing people not having to stay close to the office anymore. They can live wherever they want to. And for the San Francisco Bay Area, that means people's radius has expanded, and it's expanded out into Sonoma County. So that's why we're seeing so much higher demand, is people are moving away from the cities, they're moving back to the suburbs. Mortgage rates, how do those play into effect? Right now, Freddie Mac predicts that mortgage rates are going to stay flat for the next year. And we all know we've been at historic lows with mortgage rates. Daniel Hale, the chief economist at Realtor.com, states, we expect home sales in 2021 to come in 7% above the 2020 levels, following a more normal seasonal trend of building momentum through the spring and sustaining the pace into the second half of the year. We've had a very good winter. Generally, the winter slowed down. What we've seen instead of a slowdown in the winter is we've seen the market stay steady. So our starting off point come spring is going to be that bar is lifted higher, basically. Home price forecasts, everything from 5.9% down to 2%. I generally like to split the difference and say, okay, we're probably around a 3.5% appreciation for next year. Any foreclosure increases will likely be absorbed in the market. Back to those forbearances, if people are nervous about those, there's such high demand. We don't have a glut of foreclosures out on the marketplace. Those will be easily absorbed into the market and sold quite quickly. So the economists really aren't afraid of that. And this winter might be one of the best winters of sales activity, says Lawrence Young. On a winter-to-winter comparison, this could be one of the best breakout years just based on the fact of pending contracts that are already in the pipeline. So overall, we're seeing high demand. We're seeing a low supply. We need to keep an eye on those forbearances, as we talked about. And we need to keep an eye on that percentage of disposable income to overall debt, that we make sure that we keep that low. If those all stay the same, we're looking to have a very good real estate market. If you're interested in selling your home, we'd love to talk with you, give you an idea of what we think we could sell the house for, put together a social media video marketing strategy for you. If you found that this video has been helpful, please share it. We'd love to see you share our videos. Also, if you've got any questions, give us a call. My number's 707-217-1786. Hope you have a good New Year's. We're looking forward to a much better year this year. I think it's going to be a great year, and I hope that you have prosperity, happiness, and joy in your life. Have a great day.